I'm going to show you the top 3 strategies that you can use in a small account, large account, it doesn't matter, to grow rapidly and consistently. So what you want to do is open up a watch list of things to trade, and the first strategy that I'm going to show you is going to involve having a slight directional bias. So there's going to be 3 strategies. 2 are going to involve a small directional bias, and 1 is going to be completely delta neutral or directionally neutral. Okay, so for the first 2 trades of having a slight directional bias, we want to open up a watch list, something like these 2 here, so the 52-week near high or the 52-week near low. What this is going to do, so if we go to the 52-week near high, what this is going to do is it's going to show us a list of underlyings that are close to the highest point that they've ever been over the past year. Okay, and we're going to take the opposite side of the trade and be slightly short on these underlyings, and if you were to do the 52-week near low, you'd want to be slightly long. Okay, so we're just going to play the contrarian and take the other side, but it doesn't really matter too much. The important thing is the strategy, which we're going to get into. But before we continue, you do just want to set some filters on your watch list, and you want to eliminate anything that has earnings over the next, say, 45 days or so, because we don't want earnings to come along and potentially skew things. And you also want to get rid of anything that's not very liquid. So you only want to be left with liquid underlyings, because the more liquid an underlying is, the tighter the bid-ask spread will be, and that's what you pay every time you get in and out of a position. So the tighter the spread, the less or the more profit you're going to keep, basically. So once you've done your filters, you want to have IV rank on your watch list, and you want to order everything from high to low IV rank. And the reason why this is important is because, for anyone that doesn't know, IV rank is implied volatility rank, and so that's a metric that tells you where the volatility of the specific underlying is with respect to itself over the past year. Okay, so you can see where the implied volatility is for a particular underlying right now, relative to itself. So you can, take a look at, say, XLF. Currently has an IV of 24.1% and an IV rank of 84. So 24.1% for XLF is quite high, as we can see from the IV rank. If we look at, for example, HYG, it has an IV level of 8.1% and an IV rank of 27. So 8.1% for HYG is on the lower side. And as a general rule of thumb, you only want to look for things to trade that have an IV rank of at least 30. Over 30 is high, over 50 is very high. Okay. And so without further ado, let's get into the actual strategy itself. So you want to pick an underlying to trade. You want to pick something that's going to fit well in your portfolio. You want to make sure everything is nice and diverse. We're just going to have a look at BABA, which last traded at just over $140. The market is closed right now. That's what the price was when it last traded. It has an IV rank of 64.7 and an absolute IV level of 51%. And so now you want to pull up a list of expiration dates for that underlying, and you want to pick an expiration date to trade that's between 30 and 60 days out in time. And also you want it to be a monthly and not a weekly or quarterly expiration. So there's one here, 39 days out, April 17th, and we're going to open that up. And now we can see the options change. So we have calls on the left, puts on the right, and we are going to be selling or writing options contracts, which means that we're basically going to be short options contracts, and we're just going to play the house and let the odds and probabilities work out in our favor over time. So we have calls on the left, puts on the right, and you want to make sure you have delta. Okay, your positive deltas on the call side and negative deltas on the put side, and you want to look for things to trade. You want to look for strikes to trade based off of delta. Okay, so this BABA underlying came from our watch list, the 52-week near high. So here's our first strategy. So we want to be slightly short directionally on BABA. So what we're going to do is we're going to sell a call contract, and you want to sell around about the 30 delta level if you're just going to take one side of the trade. So if you're just going to be selling calls and not puts, you want to be at about 30 delta. Same goes vice versa if you're selling puts and not calls. So this is what we do. We sell one 30 delta call. That's at the 155 strike, and as we can see, we are now we have a negative 32 delta here on this position. So net delta. So we are slightly short. And what we want to happen is we want price to stay away from this contract. So we want price to be at or below 155 at the point of expiration, which is in 39 days time. And if it is, then we are going to keep all of the premium that we collect. So what's the actual likelihood of making money on this? Well, our pop is at 78%, so our probability of profit is at 78%, and our P50, which is your probability of hitting 50% of max profit, so you can get out 50% of max profit, and if you did want to do that, you have an 87% chance of being able to do so at some point between now and the end of the trade. So as you can see, we've got very high probabilities of success, 80-90% probabilities of success here. If we were to get filled at this mid price of $4.30, we would collect $430 up front. That's going to get added to our cash balance, and our broker is going to require just under $5,000 to open this position in buying power. Now you're probably wondering, $5,000 is a lot for one position. This is supposed to be for small accounts, all accounts, and you're right. So what I'm going to do is I'm going to show you how to reduce your buying power requirement. If of course you do have a larger account and your account can handle $5,000 buying power, I'd always recommend just to keep it simple and keep the position naked or undefined. But if you do need to reduce your buying power requirement, you can use some of this premium to buy another contract further out, and basically limit your loss potential. So let's just say we buy this 160 strike contract for $3.30. So now obviously we've used some of our premium to pay for this long contract, but now our buying power requirement has dropped all the way down to $395 as opposed to $5,000. So that's a massive difference. And if you look at our return on capital now, that's also significantly increased. So we are going to collect 105 up front, and we're going to have to put up 395. So we're getting about a 25% return here, whereas before we bought this long contract, we had a return of under 10%. We still have a P50 of 84% and a pop of 74%. So very high probabilities of success still, very high return on capital, and we are slightly directionally short on BABA. So this is the first strategy. This is how you can implement it. If you want to increase your position size a little bit, just go a little bit wider on your long. As you can see now, you'll collect more, but you're going to have to put up a bit more. And that's the first strategy. This is called a call spread, okay? And so now the second strategy is the exact same thing, but the opposite. So we're going to now go to the 52-week near low as opposed to the near high, and we're going to look for something to trade. Let's have a look here at what can we trade. Let's have a look at Oxy, okay? It has an IV rank of 74.3, an IV of 33.9%. We're going to do the exact same thing, pull up a list of expiration dates, the same expiration date, 39 days out, April 17th, and we're going to do the exact same thing, but now we are going to have a slightly long directional bias, so we're going to be selling puts instead of calls. Okay, this is the second strategy. So we're going to go again to the 30 delta. We're going to sell this, the 45 strike, and as you can see now, we have a pop of 71%, P50 of 83%. We're going to collect $109 up front, and our broker is going to require $700 in buying power to open this trade. So as you can see, we are getting over 10% return here. We're actually getting a pretty decent and respectable return for our buying power requirement. But again, I'm going to show you, if you want to reduce your buying power requirement, you can just use some of this premium, buy another contract a little bit further out, and now our buying power requirement has dropped all the way down to $188. We do collect less premium, but we need to put up less buying power. You can widen out the spread here and kind of manipulate the position to fit however you want it to. But let's just say, for example, we just keep it $2.50 wide. This is the second strategy, and now what I'm going to show you is the third strategy, which is a combination of the previous two. So the first one is we're taking just one side, the call side. The second strategy is the exact same, but we take the put side instead. And now the third and final strategy is we're going to put both of them together. And because we're putting both of them together, you don't want to be at the 30 delta anymore. You want to be at around about 15 to 20 delta. So we're going to move everything out a little bit on the put side, and now we're going to do the same thing on the call side. There's an 18 delta here at the 52.5 strike, and we're going to buy the 55 strike. And now what you can see is we've created a range for ourselves. We have a pop of 69%, a P50 of 84%. We're going to collect $50 up front, and our buying power requirement is going to be $200. Okay, so this is a directionally neutral play. We want prices to kind of stay in between our range. If you think prices are going to go higher, then just take the the put side. If you think prices are going to go lower, take the call side. If you think prices are going to stay in between, where it currently is, roughly give or take, put on both sides, and you can choose how aggressive you want to be with it. And you can choose how much buying power you want to allocate. And that's basically it. Those are the three strategies. You also need to keep in mind the buying power that you're allocating to each position. So we have created a free position sizing template that's available for everyone to use. The link is in the description. And the way it works is you simply just enter in the size of your portfolio at the top. So say if it was $50,000, you just enter that, and then you enter in whatever the current VIX level is. So say if it was 12.4, and then as you can see, everything's calculated for you. It tells you exactly how much buying power you need to use for all the different types of positions, how you should structure your portfolio. Everything's dynamically calculated based off of the amount of money you have in your portfolio and the current volatility in the market, which comes from the VIX. And as long as you're following this, you'll be absolutely fine. If you would like to learn in more detail about what we do and how we do it, click on EDS Premium. The link for this will be in the description. Get yourself signed up. You will have access to the portfolio that I showed you in this video inside, and inside you will be able to see all the positions that we place, all the adjustments, how we manage risk, how absolutely everything is fully transparent, and it's all in real time. So you can use that to reverse engineer and study, or you can copy, you can do whatever you like. And there is a full course as well, so no prior knowledge is required. We're going to teach you everything you need to know from start to finish, and it's a private community. So if you do get stuck, you can just reach out, speak to me directly, or speak to other like-minded individuals. I do personally respond to every single person, every single question. And there's a 100% money back guarantee. So after 6 months of being inside, and assuming you've been through the course and followed some of our trades, if for whatever reason you're not profitable at that point, then we'll just work with you for free until you are, or you can just request a full refund. So it's completely risk-free. It's $9.99 a month right now. That's less than a meal nowadays. And the price will be increasing. So we started off at £1 a month. It's now $9.99 a month. The price will be increasing, but once you're in, the price is locked in for you for life, so you are rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We don't want to keep you reliant. We want to give you the skill, and once you've learned it, no one can take it from you. We want to get you to that point within 6 to 12 months. So with that being said, I will see you guys on the inside.